Hello listeners, and welcome to Plugged In, the energy news podcast from Montel, where we bring you the latest news, issues and changes happening in the energy sector. Earlier this week, Europe's benchmark carbon price climbed by over €1 to reach a 7-month high. Since April, prices have been largely on an upward trend as companies across the EU rush to meet a crucial deadline. Why are we seeing an increase in carbon prices, and what is fueling this confidence boost from funds who are increasing their investments in the market? In this episode, I'll be speaking to Veyt's carbon market analyst, Ingvild Sørhus. But first, I'm joined by our carbon reporter, Bektas. Welcome back to the podcast, Jem.
Thank you, Richard.
So I think I'd like to just start, Jem, by asking you what's really, why have prices moved sort of upwardly since the summer?
Yeah, sure. So since July, the price of the benchmark X25 EUA contract had mostly been stuck in a range between 70 and 73 euros per ton. Market participants had pointed to a lack of clear direction, let's say, across the market throughout the summer. However, the X25 actually broke out of this range at the beginning of September and gradually working its way up. And last week, we saw that the X25 exceed 77 euros per ton, while this week it's traded above 78 euros per ton. And these are the highest levels recorded since mid-February this year.
And what are the reasons for those movements, Jem?
Well, I think there are a few drivers to the recent EUA rally, Richard. One of them is the looming compliance deadline on the 30th of September. This is a deadline for obliged companies to surrender allowances for last year emissions. And late purchases of carbon allowances to cover verified annual emissions is likely to have supported prices. Another factor is to do with speculative investors' net long exposure in carbon allowances, which has been steadily increasing since late August. Last week, investment funds increased their net long position to almost 69 million tons, which is the largest net length in over 4 years. I think this bullishness could reflect late compliance buying, but also preparation for a tighter EU ETS market balance next year. Sources have also pointed to the upcoming expiry of the September options contract on the 24th of September. This may have pushed the DEC 25 contract closer to the 80 euros per ton level as well.
Jem, perfect. Thank you very much indeed. So, what are the short and long-term forecasts for carbon prices? A warm welcome back on the podcast, Ingvild. How are you?
Thank you. Great, even if it's a bit kind of grey and rainy here in Oslo.
Absolutely. We want to move on to and talk about the carbon market, the EU ETS. And there's been quite a lot of activity recently, but let's sort of look at the background here. And can you describe for me how prices have moved so far this year and what have been the reasons behind those price movements in the carbon market?
Yeah, so prices started trickling up earlier this year. Basically, it was several factors. One was that we had coal in the mix. We had quite much higher emissions in the power mix, more lignite burn. So already, like in the first 3 months or the first quarter of the year, we had like 10% higher emissions than in the first quarter of 2024. And also, for quite some time, market participants have been, seeing shortage coming up in the EU ETS. And everyone was just like talking about, okay, we see this is coming. And it seemed like that was also being factored in a bit after kind of a bit slow 2024. So quite an optimistic start to the year. And then we had an election and kind of a new president in the US. And I think with all kind of talk about tariffs and threats about tariffs, probably worse than most market participants believed in, then we saw kind of a bit of a risk off in the carbon market. And of course, kind of because, the threat that would hit the European industry hard, how would that kind of hit emissions as well in the EU ETS? So it was a bit kind of a risk off, and we saw kind of after the tariff was announced in the Rose Garden in April, that prices crashed to the kind of the low so far this year. And then it recovered slightly, but been trading kind of sideways between 70 and 75 for like since May, even kind of a more narrow trading range in July and August. And then, I mean, regardless of what kind of drivers you saw, I mean, it was kind of stuck in this range. I mean, we saw kind of lower than power emissions in kind of throughout summer. And we had some bullish news, like in the, or should have been incorporated a bit bullish. For instance, the announcement of the oversupply number or the TNAC number in June, but that didn't kind of spark any major price reaction. So it's been kind of a bit, I would say, dull and just trading in this sideways range over summer. But then market participants were back, more action. And then I think the breakout of this very kind of narrow or relatively narrow sideways range, that was kind of a strong signal to test the upside. I think market participants were waiting for prices to move out of this range to one of the sides. I mean, we have had like in September also, we have had a bit kind of low wind in some instances. We have also kind of have had some higher demand at auctions as well. We have compliance deadline coming up. So activity has been quite high. I was going to say that it has been quite important to break these technical levels. We've also kind of tested again 75, but that is holding for now. So now we're kind of, we're on the way to perhaps test new levels around 80 and see kind of where prices now will established.
I mean, that's an excellent summary. I'm just wondering what you think, what will happen for the rest of the year, so in 2025, and also give us a peek into 2026 if you can.
Yeah, I mean, for just looking at kind of the fuel complex and the fuel switching prices, I mean, gas is in the money now. It seems to be kind of quite below the EUA price level. So in that sense, we don't expect much kind of more coal to be kind of favored in the power mix, which should be kind of maybe a dampening effect on prices or kind of the hedging demand for power side. But I mean, so we are getting into a more kind of exciting 2026, especially when it comes to like more kind of carbon fundamental side of things, because supply side is getting tighter. And especially, I mean, there are kind of few things that are a bit unknowns yet. I mean, we have had the publication of the auction calendar where European Commission, I mean, added quite a lot of volumes for 2026 for Repower EU, because that is kind of monetized, or part of the Repower EU plan is monetized through the EU ETS. And the target is that the sale of allowances should raise 20 billion euros. So, of course, kind of with prices being underperforming compared to what the European Commission thought when they were putting volumes to the auction calendar, that's kind of a fact. But now for kind of 2026, they seem to kind of have safeguarded a bit, adding quite a bit more volume to the market. But not all these volumes will hit the market. It will stop whenever the 20 billion target is met. Then kind of the auction and the volumes to the auctions that are kind of set aside for this purpose, they will just kind of stop coming to the market. So that's kind of a risk a bit, that we don't know how long these volumes will kind of be part of the EU common auctions in 2026. It's another thing that is a bit kind of maybe coming in from the sideline a bit is we have the shipping sector is included, or was included into the EU ETS for the first time in 2024. They have reported their emissions, or at least kind of on the way. They've been a bit slow in reporting, but they only have like 40% of compliance for 2024 emissions. So the full shipping cap pretended that it was 100% was kind of added in 2024, but that will be retroactively fitted in 2026 when we know kind of the compliance status. So the auction volume that is in the calendars now will kind of also be adjusted lower, because there has been too many allowances coming to the market in 2024 for shipping. So that's kind of, that will be as well. So it's a bit kind of these kind of supply tightening elements that will kind of also kind of be on everyone's mind for next year as well.
I think, maybe for those listeners who aren't aware what Repower EU is, that's the move, basically, the measures put in place to encourage green energy investments in Europe, is it not? To fund them, shall we say, Ingvild. So if I can pinpoint you, where do you think, you said we'd be testing 80 euros this year, in the coming weeks, maybe in the coming months. What do you think by December, where will we be? And what will all, on the supply side that you've just, very, very elegantly put together, what does that mean for prices for next year? Or what are your expectations?
Yeah, so I think we will exceed 80. I think we were more kind of getting closer to 85, 90 towards year end. Bit looking at how kind of the prices will be, or kind of the abatement cost is not reflected where the price is at the moment. So I think that will be kind of the main driver for kind of this supply shortage for 2020-26. It's a bit, we have had it a bit kind of before when for instance, the market stability reserve started, when you were getting into this or anticipated short years when the market stability reserve started, and then you had kind of also a bit kind of upfront action from participants based on it. But I think it's like a bit kind of messy supply side still. It's like this unknown how much of this Repower EU volume will hit the market, a bit kind of how much will the shipping sector kind of shipping cap will be retroactively fitted. These things are a bit kind of on the sideline, and then I think of course it will be important what happens on the emission side of things. We are seeing so far this year like roughly the same power emissions for as in 2024. We see kind of industry. There are some sectors that we'll see a bit recovery in, but still kind of, for instance, German steel industry is kind of performing quite bad. But on overall, we see kind of maybe like a 1 to 2% drop in industry emissions in 2026. But again, then it will also be important, like going forward, a bit what's happening over winter on the power side. We have seen, for instance, this year that it's been very low wind levels compared to normal levels, lower hydro levels, so it's a bit kind of this focus will also be on the emission-free power generation availability in winter as well. And then, for now, it seems like the gas market is quite comfortable, that it will kind of be sufficient gas for the winter season, at least like price-wise, looks like it. But then suddenly, if something is happening there, of course, kind of carbon prices will not live in a vacuum. It could also be kind of impacted there as well.
So if we have a winter with low wind and very cold temperatures, we've been very lucky in previous years, then we could see, an increase in gas-fired burn, potentially even coal, which will then drive emissions up. Is that kind of a summary of what you're saying there, Ingvild?
Yeah, and then it's kind of then this fuel switching levels will be important again. But for now, it seems like the fuel switching levels are quite comfortably below kind of the EUA price. For now, at least. But that could, of course, easily switch if we run into cold periods or some other with low renewables.
But you say you expect power sector emissions to be fairly flat then next year, by maybe year on year, and very little change, 25, 26, yeah. But and for industry, are you seeing any signs of an increase in production, a recovery at all in industrial production in Europe?
Yeah. We do kind of, the steel sector is, not performing greatly this year, but there are kind of signs of recovery in some other sectors. So, we don't necessarily kind of expect to see kind of a big drop in industry emissions. And that's maybe kind of on that for now, the kind of the tariffs on the EU. Of course, the steel sector is of course kind of linked to the automotive industry, but that may be kind of we had maybe worse expectations of the tariffs. So then we see kind of performance have taken or have been so far for industry.
And we discussed this in great depth in the last week's episode, the outlook for the the steel and the aluminium industries. But there was a bit of bleakness there, shall we say? But I'd like to ask you more about what's happening in the weeks ahead, Ingvild. Can you tell us a little bit more about the EU ETS compliance deadline on the 30th of September and why that is an important date for EU companies?
It's important because then you need to be in compliance for 2024 emissions. So the compliance deadline is kind of a key moment in the EU ETS. That was it's the second time when we have like the compliance deadline in the 30th of September. What is kind of we see kind of a bit on the data that is available so far that it's roughly it's getting close to 80% that is in compliance already, even if it's like some days to go. I think this time around it's a bit kind of interesting because shipping sector it's the first year where they are complying with EU ETS. When looking at kind of the verified emissions that was made available like early April, that they were kind of lagging behind on their reporting. We've seen that picked up quite a bit lately from the shipping sector, which means they probably or hopefully will be in compliance as well by the deadline. But why it's important this year is because kind of the compliance from the shipping company will make the basis of how much a cap will be, or kind of how much the auction volumes will be adjusted next year. So that makes this compliance a bit kind of special this year. And it's always this compliance is always a bit kind of, I would say, underlying supportive factor when you're getting kind of up to compliance, just because it's not necessarily that there are quite a lot that need to buy to be in compliance, but it's kind of this focus that someone might be kind of have to buy last minute to be in compliance. And looking at a bit kind of the latest status of the free allocation for 2025, there are some companies that are relying on the free allocation that is handed out to be in compliance for kind of previous year's emissions. There are some countries that are not kind of yet has quite a lot of free allocation to hand out still. They still have some time before compliance, but of course, if there are companies that are relying on these free allocation to be on their account before compliance, then it might be kind of the ones that need to go and top up whatever they need if that happens. So of course, kind of it's a bit, I think it's more kind of this underlying support that there might be someone that is in the market needs to go out and buy last minute. And then we have had, like in the past, we have had like some examples of strange things happening up until compliance. For instance, the year when British Steel suddenly had to go out and buy get the UK government to buy on their behalf just before kind of compliance. So, there are strange things happening, but we don't expect any kind of major news or something around compliance this year.
But there could be some surprises next week, because that's what you're saying as we get close to the deadline, potentially anyway. But Ingvild, what's the current situation with the phasing out of the free carbon allowances? In a way, this is where countries can basically give money to in effect to certain companies and sectors. Some countries like Germany are calling for delay. What's the current status with the phase out of these free carbon allowances?
The phase out of the free allowances, it's kind of coupled with the CBAM, also the carbon border adjustment mechanism. So of course, kind of importers needs to pay now kind of or from 2026, they need to pay kind of a carbon price equivalent to what's in the EU ETS. So basically, European industry is facing, or kind of those that are producing goods outside of Europe should kind of face the same carbon cost as companies or kind of industry in Europe to levelize the playing field. So that's basically what reallocation have been for anyway, to kind of avoid carbon leakage, or kind of to dampen that effect. Going forward, you can see kind of how the cap is decreasing by years, fewer and fewer allowances that will be kind of available to the market. And of course, if you look a bit further ahead, you can see even if you would kind of continue with free allocation, it's not much free allocation to hand out. So of course, if you want to kind of try to do something with kind of this carbon leakage question, then you want to do kind of something with incentive to European industry to kind of speed up the decarbonization for industry, but it's also kind of to give that incentive outside of Europe's border as well, because this. But of course, kind of with the phase in of CBAM, that means kind of a phase out of free allowances, and that of course kind of is debated, and you kind of, I think it was like a German minister saying this in a more kind of closed session with German industry. So we're not sure kind of if this is like the official position of Germany as of now. However, it's no kind of, I mean, this is part of the whole kind of, I mean, it's in legislation, so it's not up to Germany to say that, okay, we will just like prolong this. This is like a EU decision. So, but I mean, it's a policy discussion going on now, for instance, like on the 2040 targets. And of course, when EU has agreed on the 2040 target for next year, we also expect kind of a review of the EU ETS directive to kind of make it ready for post 2030. And of course, maybe this is a signal that, for instance, Germany or some other countries are kind of eager to take up this discussion again. But it's not something that we will see as very kind of like, I mean, CBAM is starting in 2026. The phase outs start very kind of gradually from next year. But we don't see kind of, it's really kind of a delay to the phase out of reallocation will happen in time for 2026.
I mean, it's in a sense, you can understand where it's coming from. Industry is struggling. Big countries want to help out, those kind of companies. But in effect, it's all in the legislation. There's not that much room for maneuver here, is there? Unless maybe you take it into the 2040 discussions. But anyway, a final question, really. I mean, a key indicator of market sentiment or where people think market prices are heading is the current status of investment funds' net long exposure, and in EU carbon allowances, that kind of gives a signal to some anyway. What's the current status there? Could you say a few words about that, please?
Yeah, so now, I mean, we have seen a massive increase in the net long position for investment funds over the last few weeks. So now we're basically kind of, the net positions are at the levels where we were last kind of in 2021. So it's, I mean, we had like a peak in the beginning of the year, and then we had a big kind of sell-off as well, kind of when prices were dropping. I think it was also kind of quite a lot of investor that was more kind of risk off with the whole geopolitical nervousness. Whether kind of this increase is sustainable or not, I mean, I think it came also last year based on this kind of bullish view on like a market view that it's, I mean, the realization that it will kind of be shorter and shorter by year, and also eating into this structural oversupply that has been in the market for many years. So of course, it's going to be interesting to see now whether this will more kind of stabilize around the current levels, or if we will kind of see, of course, kind of if suddenly they exit market kind of in big positions, then that will have like a bearish price impact as well. But I think it's also some that see this now kind of a bit kind of this shortage building up over, I mean, 26, 27, 28. Yeah.
So it's having an impact at the moment, and there is maybe more potential that prices will increase rather than decrease. That would be a fair analysis of that situation there, Ingvild?
Yeah, I think it's so kind of it was like market participants were a bit surprised that, for instance, that the previous or the commitment of traders report that was kind of coming out 17th of September, that showed kind of in a week where prices went down, they were still kind of building a new long positions, which I think kind of was a bit kind of surprising. And then that you saw kind of a bit kind of a price uptick for prices as well. So, I mean, I think especially with the big changes, it will be quite a lot of focus on the investment funds positions. So every kind of Wednesday when the report is coming out, I think it will be quite kind of to see kind of how this is playing out now. Yeah.
Ingvild, thank you very much indeed for being a guest on the Plugged In Montel News podcast. Thank you.
It was a pleasure to be here. Thank you.
It's been an excellent and insightful discussion. I hope you agree, listeners. And thank you for tuning in to this episode. Our podcast episodes are released every Friday. For the latest news from Montel, please visit montelnews.com, and you can follow us on LinkedIn, Blue Sky, and other social media channels. See you next time.